Hello and welcome back to another live stream on this channel. I said yesterday that we're not going to do one after the market closes because I don't think I would be able to do that. So we're doing one before the market opens, and we're going to have a look at the banks' earnings report. Most of the big banks have reported their quarterly earnings: JP Morgan, Bank of America, Citi, Wells Fargo, etc., etc. So we're going to have a look at all of that in this video. And of course, if you've got any questions, comments, please let me know down in the comment section below. I'll just double check if the yes, the sound works. That's good. I'll wait for more people to enter and sit back comfortably to listen to this live stream. Again, we're going to have a look at bank earnings. So let me start pulling up some of those. Also have BlackRock, by the way, they also reported. So yeah, overall right now, futures are again flat-ish. We also have the PPI report. We're going to have a look at that. Maybe let's do that first, and then the other ones. So 10 people already here. Welcome, welcome. Hope you're all having a good day, good morning, good afternoon, wherever you are. Leave your questions down in the chat below, or I think it's on the right, if I remember correctly. Okay, so first up, we have the PPI Producer Price Index. We had the CPI report yesterday, now the Producer Price Index. Unexpectedly slips in December, core inflation stalls. So what do we have here? It edged down 0.1% in December compared to 0.1% increase expected, and the 0.1% decrease in November revised to basically from zero. On a year-over-year basis, wholesale prices advanced 1% less than the 1.3% increase expected, and slightly accelerating from the 0.8% rise in November, revised from basically the same number. Excluding food and energy, core PPI was unchanged. So we are up 1.8% year over year versus the consensus of 1.9% and the 2% prior to that. The index for final demand goods fell 0.4% in December, marking the third straight decline. Almost 60% of the slump can be traced to a 1.2% slide in prices for final demand energy during the month. Of course, with everything that's going on right now, a lot can change in the coming months. But still, in my opinion, some good news here. Then, with regards to the banks, so if we go look at the first one, let's have a look at JP Morgan. Well, I don't know why this woman is always talking, but okay. This is the most mind-blowing thing. So the largest lender in the US reported Friday that it raked in a record $49.6 billion in annual net income, the most ever in the history of American banking industry. And it happened during the year that was the scariest for the industry since the financial crisis. Again, it's only scary if you're not strong and stable. It's very much fun times for banks like JP Morgan. That result by a buyout. Yeah, so they acquired First Republic, 31% better than its bottom line in 2022. They say here it blew all rivals away. JP Morgan's annual net income surpassed Bank of America by $23 billion and Wells Fargo by $30 billion. Quite remarkable. So, first up here on the list, Citigroup. Citigroup is now up 2% before the market opens. Reported non-GAAP EPS of 84 cents, beat the estimate by 11 cents. Revenue came in at $17.4 billion, but that missed by $1.36 billion. And we're going to see this trend actually in the next coming reports. Let's do Wells and Fargo. Wells Fargo, not Wells and Fargo. Hi, Fabio. How are you? Much better stream before market. Yeah, I mean, for some reason, let me just mute my phone for a second. For some reason, I get more viewers after the market closes. And before the market opens, I do not always have the time, but if I do, then maybe I will hop on. So Wells Fargo is down approximately 2%. So they reported non-GAAP EPS of $1.29, beat by 20 cents, and revenue $20.48 billion, beat by $100 million. Now with them, there is actually even more information. So they are hurt in Q4 by FDIC severance charges, but sees improved growth, which is probably why you're seeing right now it's down 2.24%. We're going to have a deeper look at the bank stocks in just a bit. Then we have Bank of America. Do this. Bank of America is down 2.26% right now. So it reported non-GAAP EPS of 70 cents, beat by 6 cents, revenue of $21.96 billion, missed by $1.77 billion. Quite a miss. But as you can see, most of these banks have no issues beating the EPS estimates. Most of them have issues with regards to revenue, and even JP Morgan, right? JP Morgan, as you will see, they beat EPS by 37 cents, but here as well, revenue missed by $1.21 billion. Again, with them, the expectations in the coming years are for revenue growth, basically none, flat for the next coming years. So yeah, definitely something to look at. Could it be that some fintech companies are taking market share? Maybe, but if you see how much profit this giant is generating, then yeah, I don't think they're in trouble quite yet. Plus, they all pay a nice dividend, which again we're going to have a look in just a second. Last one here, BlackRock, they raised dividend by 2% to $5.1. So they reported non-GAAP EPS of $9.66, beating the estimates by 82 cents, revenue of $4.63 billion, which was in line. Stock is down 0.6%. They announced the agreement to acquire Global Infrastructure Partners, creating a world-leading infrastructure investment platform. They have $10 trillion in assets under management, following $289 billion of full-year net inflows, including $96 billion in the fourth quarter, which was, by the way, much less than what the market was expecting. I believe the market was expecting closer to $120 billion, so quite a miss there on the inflows. So that's basically overall the picture right now with regards to bank stocks. If you want, we can have a look at SoFi. SoFi is greenish before the market opens. So yeah, that's basically the overview of the banks. We also had, for those of you that are interested, United Health reported their quarterly earnings. Their stock is down 3.51%. It's also paying a dividend, 1.39% yield. So they reported a beat, EPS by 17 cents, revenue up 14% year over year, beat by $2.22 billion. So yeah, quite nice. So maybe we'll have a look at United Health in the coming days, because I think it could be an interesting dividend play. Could be an interesting dividend play. Now, with regards to JP Morgan, we had here a couple of comments here. So Jamie Dimon, the CEO, said the US economy continues to be resilient, with consumers still spending and markets currently expect a soft landing. The economy is being fueled by large amounts of government deficit spending and past stimulus. There is also an ongoing need for increased spending. This may lead inflation to be stickier and rates to be higher than market expects. Last quarter, he said, US consumer remains healthy but are spending cash buffers. Tight labor markets and large fiscal deficits raise the risk that inflation stays elevated and rates rise from here. With regards to Bank of America, last quarter, they said we are in a healthy but slowing economy with consumer spending more than last year but continuing to slow. So, okay. I mean, not that groundbreaking of information, but I think could have been worse. Could have been worse, that's for sure. For those that are interested in Qualcomm, maybe we can have a look at that right now. Qualcomm is up 1.62% before the market opens, and that's because it got an upgrade from Citi from neutral to buy and increased the price target from $110 to $160. Maybe I'll zoom in so you can actually see something. And the price right now is at 141, I believe. Not so long ago was at 110 actually. So the analysts said they met companies across the technology supply chain at the CES conference. They noted that it appears that the dynamic random access memory, or DRAM, market continues to improve, and think that Micron Technologies is raising utilization rates and will be qualified at NVIDIA for HBM memory in the first quarter of 2024. Whew, bless me. The analysts' industry checks also indicated inventory replenishment in the wireless end market continues, and they expect upside to Qualcomm print and guide and are raising numbers, rating, and launching a positive catalyst watch. There also appears to be more cracks in the automotive supply chain, and we expect more bad news there. Okay, that's something to keep an eye on. DRAM is better, and there is a plethora of good news for Citi's top pick, which is Micron. There appears to be upside to order rates from DRAM from data centers, wireless, and PC end markets, giving lower inventory and higher pricing. So maybe we can have a look at Micron as well today. Maybe we can have a look at Micron as well. The analysts also noted that they had several negative data points from the automotive end market with microchip technology and air test system. I believe they reported guidance. Yeah, lower guidance here. Intel is executing on its manufacturing roadmap, while TSMC is having problems at 2 nanometers. As a result, they think there is a decent chance Intel can close the gap with AMD, TSM, and regain market share given Intel's superior stability and peripherals, and they believe the stock should trade at higher multiple. Okay, interesting. Okay, so first up, let's do Micron. Hello. Okay, let's do this. Micron. So currently, it's at $92 billion in market cap. Yeah, remember late 2022, it was closer to 50. Interesting. Forward PE 47.2 times. And that's because in fiscal year 2025, you can see it right here, EPS supposed to reach 6.51% and then grow 9% in fiscal year 2026 to $7.15. Sales growth fiscal year 24 and 25 a lot, so a recovery of that down cycle, but then high single-digit growth. If we're going to have a look here at, this is basically how you can see and visualize cycles, right? Go up, down cycle, up cycle, down cycle, up cycle, down cycle, and now we're probably going to go back on our way up. You can also see here, even though last time the up cycle free cash flow did not go as high as before, and now gross profit margin have reached a negative, which is why we're seeing a negative EPS for fiscal year for the fiscal year Micron is in. If we're going to have a look at the mean, so of course, when they took a hit from profitability, the E basically disappeared, but it's quickly recovering. But its 5-year mean, you have to go and look at closer at 20 times, which right now we're quite higher. And the same with all the rest. Again, expect reacceleration. So expect these numbers to drop quite dramatically. With regards to the price target, currently 14% higher, 38 analysts are covering this name. So, okay, that's Micron. They report March 26th. I thought they would have reported earlier, but okay. So let's have a look. JP Morgan. First of all, the dividend here, because it is a dividend play whether you like it or not. The annualized growth in the last 10 years is 11.53%. The last 3 years is just 4%. So again, if you bought 10 years ago, you would have gotten 38 cents. Right now, you're getting $1.05. Quite okay, pretty stable of a company. I do think they're going to increase their dividends throughout the years. If we look at their valuation metrics compared to the 5-year mean, we are getting closer to the mean. At the start, of course, with all the banking issues. When was it? Somewhere here. Then we got the crash. So yeah, still close to where it's supposed to trade, I would say. Price to sales, 3.2 times is the mean. Now we're at 3 times, so not much there has changed. If we look at shares outstanding, that has come down throughout the years. Free cash flow per share now is reaccelerating as well. But here, if we look at the growth, you can see here for sales, basically flat year over year. Gross profit for calendar year is supposed to decrease 3%. Net income supposed to drop 9%. So yeah, let's see what happens with this one. It's a company that is worth $500 billion, a bank. So that's JP Morgan. If we go look at Citigroup, Citi is also paying a nice dividend, actually. 4% here. The last 10 years, the dividend increased, annualized growth 48 cents. But if you look at the last 3 years, that's basically just 0.33% increase. So yeah, there is that. Huge debt pay down yield, which basically destroys the shareholder yield. Then if we look at shares outstanding here in the last 10 years, has come down. We're now back to free cash flow positive. The valuation, if you look at forward PE, we're now a bit more expensive than its 5-year mean. Price to sales, not much lower, but lower than the 5-year mean, lower than JP Morgan as well. If you look at the expectations for the coming years, sales growth basically flat to increasing 2% in the next 2 fiscal years. But here EPS is expected to grow 7.25% in fiscal year 24 and then reaccelerate 18.6% in fiscal year 2026. So yeah, if you want a stable player right now that pays a 4% dividend with some moderate growth, Citi probably is a good pick. If we look at Bank of America here as well, same thing as Citi with regards to sales. With regards to EPS, fiscal year 2024, a drop of 4%, but then reacceleration 6.44%. Here its dividend sits at 2.9% yield. In the last 10 years, the annualized growth of 36%, but the last 3 years, 7.72%. Still very, very well. Very good, actually. And the same story goes for Bank of America as for Citi. Debt pay down yield basically destroys the shareholder yield. If we look at valuation, a bit cheaper than its 5-year mean, bit more expensive than Citi, cheaper than JP Morgan. Shares outstanding have come down in the last, well, what is it, 7 years or so. Free cash flow per share has been negative for the last 2 years now, but is expected to be better. If we look at this right here, we are getting back on track. So yeah, that's them. Now BlackRock. BlackRock is a bit more expensive than JP Morgan, I think, with the things we're seeing right now with the valuation metrics. Is also more expensive than the 5-year mean. If you look at shares outstanding, has come down in the last 10 years. Free cash flow per share beats probably all of the peaks we've seen. Maybe JP Morgan's a bit of the same, but still quite nice. Dividend 2.52% yield, annualized growth in the last 10 years 11%, in the last 3 years close to 12%, or a bit of the same, so very, very nice. 10 years ago you got $1.93, you're now getting $5, so pretty good. Pretty good. If we look at the overview, here you can see more growth, so definitely a good pick. Close to double digit sales growth for the next 2 fiscal years, and EPS growth 5%, and then reacceleration of 14% in the next 1 and 2 fiscal years. So yeah, BlackRock definitely a good choice if you're looking for that exposure to financial sector / dividend payer. Let's see. No questions. Okay. Maybe I'll add some timestamps in this one, because I know some people like the timestamps thing. So let's do that. 1 second. Voila. And then right now, let's do. If you've got questions, let me know. If not, that's also good. So yeah, that's BlackRock. Some interesting news here with regards to the UFC. So UFC class action lawsuit, weak rights renewal could hit TKO Group. Okay. TKO Group could be negatively impacted by class action lawsuits surrounding UFC and weaker than expected media rights renewals. UFC competitive advantage as a promoter of mixed martial arts have resulted in longer-term business model risk. Glagola, okay, that's the name of the analyst, initiated coverage on the stock with a market perform rating and $92 price target, which is a bit higher than where we're at today. Interesting. Let's look at TKO for a second here. So they combine the so they are the group that combine UFC and WWE. All right. I guess we'll have to wait until Conor McGregor gets back and then probably get a short-term pump. Should do the trick, right? That should do the trick. Again, if you have questions, let me know in the chat. Should we have a look at this guy right here, Lucid Group? Quite a performance. I mean, even the unlimited money from the Saudis didn't help this piece of garbage. Again, great looking cars, business not so much. Market cap $7.46 billion with revenue for fiscal year 2025 expected to be maybe $3.87 billion. But I call BS on that number since they don't seem to be able to produce or sell cars. If we look at this report right here, Lucid Group slides to all-time low after posting Q4 delivery report. So they announced that it produced 2,391 vehicles during Q4 and delivered 1,734 vehicles during that period to beat the consensus estimate of 1,696. Wow, truly remarkable. You're producing 2,391 vehicles and you can't even deliver all of them. Okay, good luck. Good luck to them. I mean, the car, the tech, the car does look quite good, but yeah, I don't really see how they'll be able to stay alive for much longer. Yeah, more injection of money, but even that, I don't see how they'll survive. Is there something else that came out today interesting? If not, I'll cut this one short. There is an NVIDIA video that is live right now. Go watch that. Very, very interesting. Very interesting. Currently, futures are flat, as always. It's been the same for the last couple of days. Futures are flat. So, yeah. Anyways, quiet pre-market, so I won't waste much of your time. Thank you for joining, for the couple of you that did join. See you all in the next one. I hope you all have a wonderful weekend. See you in the next one. Bye-bye.